Fearless Disease.
Joining us now is Mark Zandi, Chief Economist at Moody's Analytics. All right, Mark, you're actually, this is an area that I know a little something about. So what are you thinking here? What's the thesis in terms of why you think this is such a risk in terms of AI?
Well, David, I think the so-called wealth effects generated by the surge in equity prices is driving a lot of spending and a lot of growth. The idea that people are wealthier, it's very intuitive. If people are wealthier, they're more willing and able to spend, and that's what we're seeing. It's one reason why high-end spending is as strong as it is. That's where the stock ownership is. And if you do a little, and wealth is up a lot. I mean, if you look at the total valuation of publicly traded stock, it's up $11 trillion over the past year. And so if the wealth effect is, 3, 4, 5 cents, every dollar increase in wealth generates 3, 4, 5 cents in additional spending. That arithmetic generates a lot of activity. So it just shows you how dependent the economy is to the continued rise in these AI stocks. So that's the risk. Now, are these overvalued? Are they frothy? Are they going to correct? That's above my pay grade, but I'm just pointing out that the economy is very vulnerable if they do.
Yeah.
Fearless Disease fam. Today we expose the truth they hate to hear. Like right now, if you are ready. Top economist Mark Zandi, he warns AI giants like Meta, Amazon, Nvidia, issuing 120 billion plus bonds this year could threaten the financial system. Trillions in build out ahead. We read this earlier in the tabloids, but I found a awesome review video, and he's explaining the urgency on how a lot of I would say bonds will be issued, especially coming out next year when it comes to bailing out a lot of these AI companies. And he has some pretty good points. Let's continue to hear what he has to say.
Okay, that's funny. I thought you were going to go to the data centers as a percent of overall GDP growth are so important now because so much money is being spent, instead of just the fact that stock prices are up and people have more money in their pocket. I mean, how important is the actual spend and what is occurring as a result of it to the growth of our economy, Mark?
Yeah, that too. Yeah, I didn't want to continue to ramble on, as economists are rife to do. So,
we love your ramblings, really.
Yeah. So there's really two aspects of the AI development that's powering growth. One is the wealth effect. The other is what you point out is the investment, and that is massive as well. I mean, just a statistic. I mean, there are 5,500 data centers in the United States. You total up all the data centers in the rest of the world, including China, they're at 3,500. Obviously I'm rounding, but that gives you orders of magnitude. And so It's not only the wealth effects, it's the investment spending. But David, I tie that back to the equity market. I mean, you wouldn't get this kind of investment unless stock prices were raging like they are. It just provides the currency and the license to go out and invest more, and that's what we're saying. So this run up in the equity market, which is, it's not Y2K like yet, but it's in that kind of ballpark in terms of valuation. And again, I don't want to I don't know. I don't want to draw too strong an analog to what happened back in around Y2K, but There are a lot of similarities, and we are very, very dependent on the tailwind created by AI. And if that tailwind goes soft, and then we've got the headwind, deglobalization, then we got a problem.
No, I know, but they're all in, and I mean, a lot of them are controlled companies. Mark.
That's true. We don't want to get a tailspin on that. As he explained, stocks are, of course, they're going up. Even when it comes to indices, the NASDAQ, the S&P 500, everything is going up. But once everything goes up, doesn't mean that Americans, their pockets are getting heftier. Doesn't mean that everybody's growing. It means billionaires are growing to a point where they'll make so much technology that is not going to be affordable for the American people. So when that happens, they overbuy and overcompensate and overborrow. And then once they can't pay that back because us Americans can't pay for that type of technology, they are forced to be bonded out or being saved from their debt. And that's going to be a big problem. And AI is growing at a alarming rate, which is good. But if they continue to increase the prices on obtaining that type of technology, we're going to have a big problem coming in 2026.
Zuckerberg doesn't care if his stock goes down. He's still going to spend the money. We've seen that this week. They're all talking about being capacity constrained, Mark. So any concerns there, though you may have them, coming out of earnings season have been perhaps assuaged a bit by all the commentary from these enormous companies, by the way, the biggest companies we have. We're not talking about fly-by-night outfits that were doing refrigeration and decided to move into the internet a la 1996.
Yeah, but the investment's going beyond these big companies now too, right? I mean, you've got a lot of other companies that are forming, that are IPOing, that are still privately held. A lot of investments coming from those companies, and they are dependent on their stock price and that currency and their valuations. And so, if the public equity markets start marking down the value of these companies, it's going to make it a lot more difficult for those privately held companies and companies that want to go public to do what they need to do to drive growth. And so, yeah, it's still very. You're right. It's not the same thing as Y2K, but it's in the same ballpark. It has the same kind of feel to it. But again, I mean, I don't want to send off too many alarm bells. I think the most likely scenarios we navigate through, but I just think the risk here decidedly to the downside.
Well, what's interesting, Mark, is that the companies are spending money, but they're keeping headcount flat, or in some cases, laying off. Meta just laid off 600. And I do wonder, I think we're looking at the most announced layoffs, even though we're not done for the year, for a full year since 2020.
Yeah, Carl, that's the thing that gives me a lot of angst. You know, it's clear that the job market is flat on its back, right? You can argue we have a jobs recession already. If we're creating any jobs, we're not creating very many of them. And that's even before AI really kicks into gear and causes job loss. And that feels like it's just starting to happen to some degree. And I wouldn't be nearly as worried about it if we were creating 100,000 jobs a month or 125,000 jobs a month, but we're not. And so if you start losing jobs because of AI and we start getting negative numbers, that's another reason to be nervous about what's going on here. That, you know, it all feels really good when you look at these stock prices, but there's a lot underneath it that makes me just very anxious.
A lot of people.
Very true, very true. The job market is strong, but it's not as strong as it needs to be because AI is coming in very, very fast. And it's a mix of people getting the education to learn the AI, or the regular, I would say, blue collar jobs are going to start thinning out because AI will be able to take care of them. It's a horrible sign of what we're doing as far as people, but it's actually exciting at the same time. We will see what the future holds. But as you said, they had to let go a lot of people from Meta, which is Facebook. A lot of tech companies are letting go of people because the AI is taking over. So hopefully we got some better chances coming in 2026 when it comes to people finding jobs and actually getting AI to help to assist AI, not just letting it run by itself. So that's what I got for you guys. Smash a like. Tap next video is going to be on the screen. Subscribe, hit that bell. CashApp's in the description. FearlessDisease if you want to go ahead and support the movement. See you on the next one. Stay rich and stay fearless.